As big tech starts to trend lower, the Russell 2000 has been trending higher, and that's exactly why I want to talk about 3 small cap stocks under $10 that investors should have on their radar today. We're looking at small cap names, but all of these have strong fundamentals and are companies with solid growth potential. In putting this together, I've learned that finding good small cap companies, especially profitable ones, trading for under $10 is actually quite difficult. On the other hand, the share price doesn't really tell you much at all. It's kind of a toss-up, but in contrast, it is psychologically symbolic. Some companies get stock prices that skyrocket quickly. Others even do reverse splits just to keep their stock above that $10 mark because they look more established. So what we really want are good companies that don't care about looking like good companies. My advice as an investor is not to get so hung up on the stock price itself. For a long time, all the attention was on the Mag 7 or even the Mag 10. They were around 40% of the S&P 500 at one point, and people were getting more and more worried about the market becoming too concentrated. We've seen some pullback there, and now the gains are spreading out to more traditional stocks, which is a positive development because it creates a healthier market. The Russell 2000 has been doing pretty well over the last year and continues to move higher even over the last month. In many ways, the loss of the Mag 7 has become a gain for the Russell. We'll start with the first stock, Aveanna Healthcare, ticker AVAH, trading around $9.70. The company offers home health care generally for patients with complicated or expensive medical needs. Home health care is a growing market, and about 91% of its revenue comes from Medicare and Medicaid. Insurers generally like this model because it is far cheaper to care for a patient at home than it is to keep them in a hospital with expensive equipment and constant monitoring. Over the past year, the company reported 16% revenue growth, and management has raised its 2026 revenue guidance twice during this period. That's always a good sign, as it means the business is doing better than management had originally thought. They are in 39 states, and this is still a relatively small company with a market cap of about $2 billion and annual revenue of about $2.1 billion, so it could eventually become an acquisition target. Maybe it's a bigger home health company, a large insurer, or even private equity that looks at it and says, that's small enough to buy. I wouldn't expect this to be a stock that goes up tenfold in a year. This isn't a semiconductor company or some kind of explosive AI story. I think it's the type of company that could consistently beat the market over time and maybe one day be acquired. I think of these stocks as watch list stocks. I'm not saying that everyone should go out and buy Aveanna Healthcare. I'm saying it's interesting enough to warrant a closer look. I think I worry a lot less about a stock already up 100% with very small companies because these businesses still have so much room to grow. Big institutions often can't build meaningful positions in tiny companies without moving the stock price themselves. It's one of the few areas in which retail investors still have a true edge. Small caps, and especially micro caps, remain one of the few places in the market where individual investors can still compete on something close to an even playing field. Aveanna is definitely on the steadier side of the spectrum in terms of healthcare. It's only in-home healthcare. There is no AI that can replace it. Biotech, however, is far more volatile. That said, the other reason I find biotech interesting is the sector had a massive washout. The biotech companies went public in a flood around 2021, but the FDA only approves about 50 new treatments a year. The math just didn't make sense. Thousands of companies chasing a very limited number of approvals. Now, a lot of that excess has been worked out. If you're looking for more risk, biotech may be worth looking at later. But if you're just looking for some healthcare exposure with a more stable business model, I would take a much closer look at Aveanna Healthcare. I think healthcare has lagged in recent years behind its longer-term potential because of the investor focus on AI and the Mag 7. But if you step back, we spend about 18% or 19% of US GDP on healthcare. We spend a lot of money on this, and we have an aging population with millions of baby boomers moving further into retirement. Those demographics are a strong plus for healthcare. It is the very sectors that you should be looking at that have had a bit of a lackluster 5-year run. The second is Genworth Financial, which is trading near $9.20 a share. Genworth is an insurance company with about $7 billion in annual revenue and trades at about 17 times earnings, below the S&P 500. It actually breaks its business down into two very different parts. First, it owns about 82% of Enact, a private mortgage insurer. The private mortgage insurance market in the U.S. has been growing at about 8% a year, well ahead of the growth in overall GDP. It's not a sexy industry. Come on, it's a little dull. But the boring companies pay the bills. And for the sake of this discussion, I wanted to focus only on profitable companies. Genworth earns money. They own the mortgage insurance business with net profit margins of around 55%. That's a lot if you are somewhat new to investing. Those profits help to offset the second part of the company, which is a legacy book of long-term care insurance policies written back in the 1990s and early 2000s. Unfortunately, those policies were severely underpriced. The company no longer writes policies, but it still spends $300 million to $400 million a year servicing the policies it has on its books. Those liabilities will just roll off eventually, and the problem will be gone. If you look at the long-term stock chart for Genworth, you will see a dramatic collapse during that tough period. But look at the last 5 years, and the picture changes dramatically. They spun off a portion of the mortgage insurance business, maintaining majority ownership. The stock has been climbing steadily. That business has been doing really well and has been covering the bills. It's a bit of a complicated story, but that's really what attracts me as an investor. I like complicated. I will check out businesses that might not have good curb appeal. I'm seeking companies that are a little ugly on the surface, but much healthier underneath. Genworth is one of those companies. This is not some dramatic corporate reinvention. The move they have made is straightforward and still very much in the insurance business. More importantly, it's already doing the work. The bulk of the business now is the mortgage insurance operation, which is very profitable. Those 55% margins are impressive on their own. The mortgage insurance market itself grows about 8% a year. And if Enact is better than average, it grows maybe 10%, 11%, or 12% in the long run. It might grow faster today, then reach stability. Again, the stock is not likely to be a 10-bagger. If that is your thing, there is no shortage of unprofitable sub-$10 small-cap companies to gamble on. But I care about quality. That's a good trade-off because most stocks just don't create wealth, and you're giving up some upside by focusing on profitable businesses. According to a study by Arizona State University professor Hendrik Bessembinder, just 3.2% of U.S. stocks have generated almost all of the market's long-term wealth creation since 1924 and up until about 2023. Most stocks actually lose investors' money, and a surprisingly large percentage eventually go to zero. That is why the importance of financial strength and a proven business model increases so much when considering smaller companies. I also find it interesting that Genworth has performed well in a rising interest rate environment, which is challenging for housing. If they can produce these kinds of results in a high-rate, low-housing inventory environment, there is hope the business could do even better if rates come down and housing transactions increase. One reason I like insurance is that it's a slow, steady, somewhat boring business. There is nothing glamorous about this. It's essentially a math business. Insurance companies collect your premiums and then pay out claims. That cash is called the float. The float has traditionally been invested predominantly in Treasury securities. Warren Buffett famously realized that he could use that float to buy stocks instead, and many insurance companies have followed that model, making the business considerably more profitable. The insurance industry also divides along different lines. There's reinsurance, which is insurance for insurance companies against big disasters. Then you have the specialty insurers. Personally, I tend to prefer specialty insurance companies as they tend to have more pricing power. Take, for example, Markel. It writes highly specialized insurance products and is sometimes called a mini Berkshire Hathaway. Their tagline is, if you haven't heard of it, they probably insure it. Their niche expertise enables them to command high prices. I like Genworth's mortgage insurance business, but specialty insurance generally has even more compelling competitive advantages. Third is eGain, EGAN, trading at around $6.57. With a market cap of only about $175 million, the stock is a true microcap company, and investors need to be careful. This is not something I would load up on for sure. Stocks this small can swing wildly for no apparent reason. Interestingly, eGain has actually been around since 1997. It's holding up very well. The company even did a 20-for-1 reverse split just to stay on the listing, but somehow it gained traction. Years ago, it generated $80 million to $90 million in annual revenue and stayed profitable. Then came AI, and the company rebranded itself as an AI-powered customer service company. At first glance, the claim sounds like marketing hype. However, customer service is one area where artificial intelligence can really add value. The numbers look good. Their traditional customer retention rate is 101%, which means that customers actually spend a little more over time. Their AI is 116% effective at retention of customers. It's still pretty new, so we don't have years of data, but early signs are that the AI products are resonating with customers so far. The stock itself has been volatile. It was trading at about $15 a year ago and is now in the $6 range. I think the market is still trying to figure out if the firm is an AI company or not. The stock trades at around 4 times earnings. What I like about this is that it isn't a company created to take advantage of the AI trend. It's a business that's been running for close to 30 years and has been profitable the whole time. Even if the AI opportunity doesn't quite pan out, there's a business underneath that's been running for 30 years. That's a floor under the investment, in a way. Its customer roster also includes such organizations as the IRS, LL Bean, and JP Morgan. These are real business users using their software. Customer service is one of the most labor-intensive functions inside most organizations, so AI has the potential to make a material impact there. The bigger question the market has been grappling with is whether AI is a friend or foe. Investor sentiment shifts week on week. Often, software companies have become so deeply integrated into their customers' operations that it is not as easy to switch as some people make it sound. AI is able to automate 94% or 96% of a task, but that last few percent might be important enough that companies don't want to switch providers. One reason I think the sell-off among the software as a service names has been overdone. And with eGain, there's the added element that it's just a small, a little obscure company, so the stock is naturally going to get thrown around much more aggressively than that of larger businesses. The company has also been beating expectations all along the way. Yes, about 75% of companies beat analyst estimates, so earnings surprises are not terribly meaningful by themselves. However, many software companies have also seen strong operational results. The fundamentals are still stronger than the market believes. That's what drew me to eGain in the end. But as an investor, I always go back to the idea of looking where the market is not looking. You are going to make money when you find opportunities that other people are not seeing. It's interesting when you see a company with relatively healthy fundamentals being penalized by the market. For decades, academics have been trying to figure out the perfect level of diversification in a portfolio, and I don't think they'll ever find the magic number because investing is fundamentally a social science. Warren Buffett has said that if he had to start over today with just $1 million, he thinks he could get 50% annual returns. In fact, he said he knows he can. He'd be looking at microcap companies because that's where the individual investor has the greatest edge. The big hedge funds can't really invest in microcaps, so this gives retail investors one of the few remaining edges in the market. The opportunity is there if you're willing to do the homework. Thanks for watching. Please subscribe to the channel.